Welcome to FinScribble. When you think about artificial intelligence reshaping the global economy, your mind probably jumps straight to skyrocketing tech stocks or revolutionary workplace automation. But AI's single biggest impact on your everyday household wallet might actually show up in a far more boring, unassuming place: the interest rate on your mortgage. If you have been sitting on the sidelines for months or even years, patiently holding out for those ultra cheap 3% mortgage rates to make a glorious comeback before buying your dream home or refinancing your existing loan, you are definitely not alone. Millions of hopeful buyers across the country are playing the exact same waiting game right now. However, understanding how AI is quietly restructuring the global flow of money reveals a surprising truth. Waiting for yesterday's normal might mean waiting for an economic past that is simply never coming back. To understand why interest rates are stuck high, we first need to take a look at how home loans are actually priced. Most people assume the Federal Reserve directly sets their local bank's 30-year fixed mortgage rate, but that is not quite how the financial machinery works. Mortgage rates are actually anchored to long-term government bonds, specifically the 10-year Treasury yield. Here is our homebuyer, Maya, watching an interactive chart where historical mortgage interest rates plummeted down to historic lows of 3% between 2020 and 2022. Maya is sitting on a bench with her savings account ready, waiting for that golden line to drop back down to where it used to be. Jordan steps into the picture to show her that underlying structural forces have shifted the entire foundation underneath that graph. What felt like a temporary spike is actually a fundamental reset of the baseline market environment. The first major force moving rates higher is what economists call the economic channel. Artificial intelligence is unleashing immense productivity gains across software, medicine, manufacturing, and finance. In economic theory, when business productivity leaps upward, the economy can grow much faster without constantly triggering runaway inflation. This structural shift permanently pushes up what central bankers refer to as R star, or the neutral rate of interest. R star represents the theoretical baseline interest rate, where the economy is neither expanding too fast nor contracting. Think of R star like an ocean tide mark on a sandy beach. As AI productivity surge waves wash onto the shore, the baseline tide mark rises higher. Because R star is now higher, the Federal Reserve's restrictive threshold moves up along with it. Rates that feel painfully high to us today are actually just the new neutral baseline required to keep our economy balanced. The second major engine driving mortgage rates is capital competition. Right now, tech megacorporations are pouring over $300 billion annually into artificial intelligence infrastructure, building massive data centers and advanced chip facilities. Picture a gigantic, glowing AI server grid acting like a powerful magnet in the middle of Wall Street. This AI capital magnet is pulling hundreds of billions in private investment away from traditional government bond vaults. When huge sums of global capital flow into technology infrastructure rather than buying treasury bonds, bond issuers must offer higher interest yields to attract investors. Because mortgage rates directly mirror these bond yields, mortgage borrowing costs get dragged upward right alongside them. The era of 3% mortgage rates was not a sustainable standard. It was a brief historical anomaly driven by unique economic conditions that massive AI infrastructure investment has now permanently rewritten for good. So, what does all this mean for your home buying strategy? Staying frozen on the sidelines while waiting for interest rates to drop back to 3% is a losing strategy that keeps your financial life on hold. Jordan helps Maya open an interactive financial planning dashboard calibrated for a realistic 5.5 to 6.5% rate environment. Instead of trying to time unpredictable macroeconomic cycles, smart homebuyers are actively shifting their focus toward controllable financial leverage. They are negotiating seller price concessions up front, exploring flexible, adjustable rate options, or purchasing smaller starter properties to begin accumulating wealth equity today. When you adjust your personal expectations to align with macroeconomic reality, you reclaim complete control over your balance sheet. Higher interest rates certainly require smarter planning, but they should never stop you from making well-reasoned, long-term investments in your family's financial future. Understanding the broader forces shaping our economy allows you to make confident decisions rather than reacting out of fear. Maya steps away from the sideline bench, standing alongside Jordan as they look out over a thriving suburban neighborhood filled with modern homes. Artificial intelligence is quietly transforming everything from global productivity to local mortgage yields. But armed with the right knowledge, you can navigate these structural shifts with total confidence. Don't let yesterday's interest rate baselines hold back tomorrow's major financial milestones. If you found this breakdown insightful and want to stay ahead of the quiet economic forces impacting your personal wealth, share this video with anyone who is currently waiting on interest rates. Be sure to hit that like button, subscribe to the FinScribble channel, and ring the notification bell so you never miss another actionable financial guide. As always, appreciate you hanging out today. See you in the next one.